If you have a high-yield savings account right now, you probably feel like a genius. For the first time in 15 years, cash is no longer trash. We are seeing banks compete for our attention with shiny 5% yields. It feels like a golden ticket. But I am here to tell you that 5% is a mirage. By the time the IRS and your state government finish with your account, that yield isn't just smaller, it is often barely keeping your head above water. In some high-tax states, a 5% return is actually a 2.4% return after everyone else takes their cut. You are essentially doing all the work of saving while your silent partner, the IRS, takes almost half the reward. Today, I am going to show you the tax bracket math that the banks hope you never calculate, and more importantly, exactly where you should be parking your cash instead to stop the bleeding. Before we dive into the spreadsheets and the tax codes, I want to make a deal with you. Most people will click away the moment they hear the words marginal tax bracket. But if you stick with me for the next 20 minutes, I'm going to give you a framework that could save you thousands of dollars in unnecessary taxes every single year. This is the highest return on investment you will find today. If you find this helpful, consider joining the optimizers by clicking that join button. It is how we keep the lights on and keep these deep dive reports coming to you without any corporate sponsorship. Now, let's look at why your bank account is lying to you. We see that 5% annual percentage yield, or APY, and we anchor our expectations to it. If you put $100,000 in, you expect $5,000 back. But in personal finance, the only number that actually matters is your net after-tax real return. And that number is currently under attack. To understand the trap, we first have to understand the mechanics of the high-yield savings account. For over a decade after the 2008 financial crisis, the Federal Reserve kept interest rates near zero. Banks had no reason to pay you for your deposits because they could get money for free elsewhere. But when inflation spiked, the Fed moved aggressively. Suddenly, the cost of borrowing skyrocketed, and banks needed your cash to fund their loans. This created the arms race we see today. Online banks, which do not have the massive overhead of marble lobbies and thousands of physical branches, started offering 4 and 5% yields to attract your liquidity. It looks like they are doing you a favour, but they are simply paying you the bare minimum required to keep your money from leaving. The problem is that while the bank is paying you more, they are also handing a detailed report of every penny you earn directly to the IRS. To the government, the interest from your savings account is not a special investment reward. It is treated exactly like the money you earn from your grueling 9-to-5 job. The 5% you see in bold letters on your banking app is what economists call the nominal rate. It is the face value of the yield, completely unadjusted for taxes or inflation. We have a psychological bias toward these nominal numbers. We see a larger number and we feel wealthier. It is a recognized behavioral finance phenomenon. But the IRS does not care about your psychological comfort. They see that interest income as ordinary income. In the world of taxes, ordinary income is the most expensive kind of money you can make. If you buy a stock and sell it for a profit after a year, you pay long-term capital gains rates, which are relatively low. But bank interest? That gets stacked right on top of your salary. It is taxed at your highest possible marginal rate. This means that if you are a successful professional, you are not really earning 5%. You are earning 5% minus a massive chunks of federal, state, and local taxes. I have noticed that most people treat their savings account as a safe haven, but from a tax perspective, it is actually one of the most inefficient places you can put your money. You are paying a massive premium for the ability to move your money instantly. That premium is the tax drag. When you leave a large balance in a high-yield account, you are effectively choosing to pay the highest tax rate possible for the sake of convenience. It is like paying a 30% convenience fee on every dollar of interest you earn. Most of us wouldn't pay a 30% fee to use an ATM, yet we do exactly that every time we let a large cash reserve sit in a standard taxable bank account. The banks love this because your money stays on their balance sheet, and you are the one stuck with the tax bill at the end of the year. We are going to look at the specific tax brackets in a moment, but first you need to realize that the safety of a bank account is often an illusion that masks the slow erosion of your wealth. My protocol for cash management starts with a simple rule. If the money is not for an emergency happening in the next 30 days, it probably shouldn't be in a bank account. We have to stop thinking of all cash as one single bucket. We need to categorize our money by its purpose and its time horizon. The high-yield savings account is an excellent tool for your first few months of living expenses. It provides that instant T+0 liquidity you need if your water heater explodes. But using it for a house down payment or a long-term cash reserve is a mathematical mistake. If you think that 30% tax hit is bad, wait until you see what happens when you live in a high-tax state and cross the income threshold for the net investment income tax. That is where a 5% yield starts to look like a complete disaster. Let's break down the actual federal brackets so you can see exactly where your yield is disappearing. In the eyes of the IRS, interest income is just another form of ordinary income. This is a critical distinction. If you were to earn money through dividends or long-term capital gains, you might pay 15%. But bank interest is added directly to your W-2 wages or your freelance income. Because the United States uses a progressive tax system, this interest is taxed at your highest marginal rate. It doesn't get the benefit of the lower brackets that your first few $1,000s of salary enjoy. It sits right at the top. For 2024, those federal brackets jump quickly from 10 and 12% to 22, 24, and even 37%. If you are a single filer earning over $100,000, nearly a quarter of your interest is gone before you even see it. And that is only the beginning. The federal government is just the first person standing in line to take a piece of your savings. The state government is right behind them, and in some places, they are just as hungry. Unless you are lucky enough to live in one of the 9 states with no income tax, like Texas or Florida, you are also paying state income tax on your interest. This is known as the SALT factor. These rates vary wildly and can drastically change the math of your savings. In a state like Pennsylvania, it is a flat 3%. In Massachusetts, it might be 5%. But if you live in California, New York, or New Jersey, you could be looking at another 10% or more being shaved off the top. And if you live in a place like New York City, you have city income taxes piled on top of that. This is the silent killer of the high-yield savings account. Most people check their account balance and see the interest deposit, but they don't realize they have a deferred liability building up. You are earning that interest in July, but you won't feel the pain of the tax bill until the following April. By then, the 5% you thought you earned has already been spent or eroded by inflation, leaving you to pay the tax bill out of your current pocket. For high earners, there is a third, more secretive layer of taxation called the Net Investment Income Tax, or NIIT. This was created as part of the Affordable Care Act, and it adds an extra 3.8% tax on top of your investment income, including bank interest. This applies if your modified adjusted gross income is over $200,000 for individuals or $250,000 for married couples. When you add federal taxes of 32 or 35%, state taxes of 9%, and the NIIT of 3.8%, your total tax rate on that interest can easily exceed 45%. Think about that for a second. You are doing all the heavy lifting of saving your money, and the government is taking nearly half of the reward simply because you chose the wrong vehicle. A 5% yield in this scenario is effectively 2.7%. This is why the wealthy rarely keep massive amounts of cash in standard bank accounts. They know that the tax code is designed to punish this specific type of behavior. I want you to memorize a very simple formula so you can protect yourself. To find your true yield, you take the nominal yield, and multiply it by 1 minus your total marginal tax rate. If you are in the 24% federal bracket and a 5% state bracket, your total rate is 29%. 1 minus 0.29 is 0.71. Multiply 5% by 0.71 and you get 3.55%. That is your reality. Most people stop here and lose tens of thousands of dollars over a lifetime because they don't realize there are other options that are legally exempt from these taxes. We are going to look at those in a minute, but first, we need to run a real-world case study to show you how this looks in practice. Because if you think 3.5% sounds okay, you are forgetting about the other thief in the room: inflation. This is the opportunity cost trap that keeps the middle class from ever reaching true financial independence. Let's look at Sarah. She is a corporate professional in Virginia earning $105,000 a year. She has saved $50,000 for a house down payment, and she is proud of her 5% high-yield savings account. On paper, she earns $2,500 in interest. But Sarah is in the 24% federal bracket and the 5.75% Virginia bracket. Her total tax rate is almost 30%. After she pays $743 in taxes, she only keeps about $1,700. Her 5% yield is actually 3.5%. But wait, it gets much worse. If inflation is running at 3.2%, we have to subtract that from her after-tax yield to find her real return. 3.5 minus 3.2 leaves Sarah with a real return of 0.3%. Sarah thinks she is building wealth, but in terms of actual purchasing power, she is essentially standing still. She is running as fast as she can just to stay in the same place. If inflation ticks up just a little bit, her real return becomes negative. Now consider David and Elena in Los Angeles. They earn $750,000 combined and have $500,000 in cash waiting for a real estate opportunity. They are in the top 37% federal bracket. They pay the 3.8% NIIT, and California takes another 11.3%. Their total tax rate is over 52%. When their $500,000 earns $25,000 in interest, they have to write a check to the government for over $13,000. Their 5% high-yield account is paying them a net yield of 2.39%. Since inflation is currently higher than 2.39%, David and Elena are literally losing money every single day that cash sits in a bank. Their purchasing power is evaporating. For a high earner in a high-tax state, a high-yield savings account is not an investment. It is a wealth destruction engine. This is why understanding where to put your cash instead isn't just a tip. It is a necessity for survival in this economy. The great paradox of the high-yield savings account is that it feels safe because the number on the screen never goes down. In a stock market crash, you see red and you feel pain. In a savings account, you only see green. But this is a trick of the mind. Your balance is going up, but the value of each of those dollars is going down faster than the interest can replenish them. This is the difference between nominal yield and real yield. If you aren't calculating your return after taxes and after inflation, you are flying blind. We are living through a period where inflation is sticky. Even if it settles at 3% and you are paying 30% in taxes on a 5% yield, you are barely breaking even. You are working hard for that money, but the money is not working for you. It is merely surviving. To actually build wealth, you need to find vehicles that offer the same safety as a bank, but with a much lower tax burden. This is where the smart money moves, and it is simpler than you think. If you want the ultimate alternative to the high-yield savings account, you need to look at the very entity that is taxing you, the United States government. Treasury bills, or T-bills, are short-term debt obligations backed by the government. Right now, they often yield more than 5%, sometimes even more than the best savings accounts. But here is the secret. Interest from T-bills is 100% exempt from state and local taxes. For someone like Sarah in Virginia, moving her money from a bank to a T-bill instantly increases her take-home pay by nearly 6%. For David and Elena in California, it is an 11% raise on their money overnight. We will get into the exact portfolio allocation and how to buy these in a minute. But first, we need to address the holy grail for the highest earners, because it is the one thing your bank will never tell you about. For high-income earners in the top tax brackets, municipal bonds are a game changer. These are loans you give to states or cities to build schools and bridges. To encourage people to invest, the federal government makes the interest 100% tax-free at the federal level. And if you buy a bond from your own state, it is usually state tax-free as well. This is what we call double tax-free income. If you see a municipal bond yielding 3.5%, it might look worse than a 5% savings account. But if your tax rate is 50%, that 3.5% is the equivalent of a 7% taxable yield. You are effectively earning 2% more by choosing a lower yielding, tax-exempt asset. You can access these easily through municipal money market funds at any major brokerage. They provide similar liquidity to a savings account, but without the massive federal tax bill. This is how the wealthy stay wealthy. They don't look for the highest number, they look for the most efficient one. Another powerful tool is the Series I savings bond. These were designed specifically to protect your purchasing power from inflation. They have two major tax advantages that a bank can't touch. First, like T-bills, they are exempt from state and local taxes. Second, they offer tax deferral. In a savings account, you pay taxes every year as you earn the interest. This creates tax drag, where your money is constantly being chipped away, preventing it from compounding. With I-bonds, you don't pay a single penny in federal tax until you cash the bond in, which could be decades from now. This allows your interest to compound on the gross amount, not the after-tax amount. There is even a provision where if you use the money for qualified education expenses, it can be entirely tax-free. There are limits on how much you can buy each year, and you have to hold them for at least a year. But for a portion of your long-term cash, they are mathematically superior to any bank account. We also have to talk about asset location. This is the concept that where you hold an investment is just as important as what the investment is. If you have cash that you don't need for several years, holding it in a taxable bank account is a mistake. If you hold a high-yield certificate of deposit, or CD, inside a Roth IRA, you pay zero taxes on that interest. Your 5% yield stays 5%. If you hold it in a traditional IRA, the taxes are deferred until you retire, when you will likely be in a much lower tax bracket. I see so many people holding low-growth stocks in their IRAs while keeping high-interest cash in their taxable bank accounts. This is backwards. You should prioritise putting your most tax-inefficient assets, like high-interest cash and bonds, into your tax-advantaged accounts. This simple shift in strategy doesn't require you to earn more money. It just requires you to be smarter about which pocket you put it in. It is one of the easiest ways to optimise your net worth without taking on a single drop of extra market risk. Finally, we have to look at the most overlooked alternative: paying down high-interest debt. If you have $20,000 in a savings account yielding 5%, which we've established is actually 3.5% after taxes, but you also have a car loan at 7%, you are losing money. Paying off a 7% loan is the mathematical equivalent of earning a guaranteed, tax-free 7% return. To get a 7% return after taxes in the stock market or a bank, you would need a nominal yield of nearly 10%. You won't find a guaranteed, risk-free 10% yield anywhere on earth. By paying off your debt, you are creating your own high-yield investment that the IRS cannot touch. This is a holistic view of your balance sheet. Don't be so enamored with the interest the bank is paying you that you forget about the interest you are paying to someone else. Taxes turn your 5% savings into a 3% gain. But debt turns your 7% loss into a permanent drain on your wealth. To truly take control, you must learn the tax equivalent yield formula. It is the Rosetta Stone of investing. It allows you to compare a tax-free bond directly to a taxable bank account. The formula is simple. Take the tax-free yield and divide it by 1 minus your marginal tax rate. Let's go back to David and Elena. They were looking at a 3.2% California municipal bond. They thought the 5% savings account was better. But when we run the math, 3.2 divided by 0.48 equals 6.66%. This means a bank would have to pay them over 6.5% to match what that municipal bond is paying them. Since no bank is paying 6.5%, the municipal bond is the clear winner. If you don't run this calculation, you are making decisions based on the wrong numbers. You are picking the taller horse, even though the shorter one is faster. Start asking yourself, what is the tax equivalent yield of this move? Once you start thinking this way, you will never look at a bank advertisement the same way again. So, how should you actually structure your life? I recommend a tiered cash management system. Tier 1 is your checking account for monthly bills. Don't worry about yield here, focus on convenience. Tier 2 is your immediate emergency fund, 1 to 3 months of expenses. Keep this in a high-yield savings account. Yes, it is tax inefficient, but you are paying that tax as a premium for instant access. It is an insurance policy, not an investment. Tier 3 is where things change. This is your short-term savings for goals 1 to 3 years away. This should be in Treasury Bills or state tax-free money market funds. You get higher yields and lower taxes. Tier 4 is for money you won't need for 3 to 5 years. This is the place for Series I bonds to protect against inflation. And Tier 5 is for wealth building, 5 years and beyond. This is where you move away from cash entirely and into broad market index funds where you can benefit from long-term capital gains rates and tax deferral. This system ensures you have the liquidity you need while minimizing the amount of money you leave on the table for the IRS. It is important to understand that the tax code is not just a way for the government to collect money. It is a behavioral engineering document. The government taxes bank interest heavily because parking cash in a bank doesn't do much to grow the economy. They want you to move your money into treasuries to fund the government, or into municipal bonds to build schools, or into the stock market to fund companies and create jobs. By offering tax breaks for those things, they are telling you exactly what to do with your money if you want to keep more of it. When you leave a massive balance in a savings account, you are fighting against the incentives of the system. Financial literacy is the ability to read these incentives and align your actions with them. Stop fighting the current. When you move your cash into more tax-efficient vehicles, you aren't just saving money, you are playing the game the way it was designed to be played. The 5% high-yield savings account is a great tool for beginners, but as you grow your wealth, it becomes a trap. True financial freedom is not about how much you make, it is about how much you keep. Don't let the shiny nominal numbers distract you from the reality of your tax bracket. Take a look at your accounts this week. Calculate your total marginal tax rate. Run the tax equivalent yield on a Treasury bill or a municipal bond. You might find that you can give yourself a 1 or 2% raise just by moving your money across the street. If you found this breakdown valuable, let me know in the comments what your current cash strategy looks like. I read them all for peer review and to see what the community is noticing in the markets. And if you really want to take it to the next level, I'll see you inside the Optimizers membership area. Until next time, stop chasing yields and start chasing efficiency.